The Federal Reserve's strong dollar policy, a recipe for systemic implosion. This is authored by Matthew Pippenberg via goldswitzerland.com on Zero Hedge. From Main Street, USA to the village corners and central banks of Europe, Japan, and elsewhere, the Fed's strong US dollar policy is backfiring big time. Just ask the Brits. Having spent years creating the inflation QE1 to unlimited QE, repo bailouts, massive money supply expansion, and a historic wealth transfer from an inflated Fed-driven stock market, the Fed will be cleaning up its own inflation mess on the backs of the US working class and its other global allies, quote unquote, while blaming the CPI inflation on Putin, Russia, COVID, and climate change, and etc. How's that for rigged to fail? But that's just the beginning, and it's not just about the USA. Engineering a recession Powell can't control. By raising rates into what we all know is a recession, now we know that the UN is demanding that all central banks, including the Fed, that is putting basically tying up Powell's hands, they want to stop rate increases and put a cap on prices. Hopefully that'll happen. Now, by raising rates into what we all know is recession, Powell, who delusionally pretends to be Volcker reborn, wants to solve the inflation he helped create by engineering a demand-crippling recession, which he thinks he can control but can't and will not. And this will be the mother of all recessions, as there is a historical and concomitant debt and hence currency crisis in every corner of the globe. $300 trillion plus, as well as every corner of the nation, $90 trillion plus. From the toxic corporate bond market and overstrapped households to a grotesquely bloated 30 trillion plus government debt market. Keep it horribly simple. It's horribly simple, in fact. If debt is the everywhere driver of the economy and markets, then any significant increase in the cost of that debt will destroy every corner of that economy and those markets, from zombie enterprises to negative yielding US treasuries. Powell's hawkish stance will lead to anything but a contained recession, quote unquote, which the Federal Reserve will be no less effective containing as they were in containing their so-called transitory inflation. Raising rates will cripple nearly every asset but the artificially inflated US dollar until all savings are gone. Most citizens are handout dependent, and most markets and currencies are on their knees. At that point, Uncle Sam will either default on the IOU Treasury bonds, which no one will want, or the Fed will pivot to more mouse-click money to buy and support his debt addiction, following the recent example in the UK. And since the US is too arrogant to fail and default TAF, the Fed's only stupid choice left among the long history of stupid will be a gold-boosting quantitative easing pivot, QE pivot. When? Yes, an inevitable pivot. So again, when will Powell pivot? After the pain, politics, and panics have reached levels the US and global economy and markets have not seen since the FDR era, Powell will throw in the towel and pivot. In the interim, the US, as well as global middle class, can think Greenspan, Bernanke, Yellen, Powell. They can thank them all for all the pain ahead, as it is the direct, and I mean direct, result of years of unprecedented drunken free money and bloated debt, the hangover for which is going to be a record-breaking 7%. Now, a treasury market on the cliff's edge. Investors are forgetting that not only is hawkish Powell raising rates into a debt bubble, he's slowly tightening the Fed's balance sheet, which just means dumping more treasury supply into a demandless sovereign bond market. And this supply stream means bonds will fall even further, and hence their yields and interest rates will keep rising, thereby by adding massive insult to the already fatally injured credit debt market. I feel that when USTs, U.S. Treasury bonds start to tank en masse, Powell's fantasy of being the next Volcker will end and the pivot towards money printing will be fast and furious, sending precious metals to record highs. But until then, buckle up. Powell's master dollar plan, foreign suckers. For now, Powell's plan is to let rates, yields, and hence the dollar rise in the hopes that the greenback will be the only place left for global investors and suckers to hide, which is where they are indeed beginning to hide. It's only a matter of time, however, before foreign investors, nostalgic for the days of former U.S. glory, realize that such glory is gone and that the only way U.S. Treasuries will ever be risk-free return is if the Fed prints more debased money to buy them, which is not Powell's current practice. In essence, then, foreigners are not hiding in risk-free return, but drowning in return-free risk, as even 3 to 4% yields on the U.S. 10-year Treasury yield is a negative minus 5% return when adjusted for inflation, despite it being underreported by 50%. Remember when I said the Fed has no good options left? I meant it. It's either tighten and risk systemic collapse or ease and destroy the currency. Pick your poison. Furthermore, and ironically, the US dollar, hence world reserve currency, is highly illiquid despite being mouse-clicked for years. For this USD scarcity and the immense pressure it is putting on the US-denominated debt holders and sovereign financial partners, we can thank that other poison known as the quadrillion-dollar derivatives market, of which I've already written. Losing faith in Uncle Sam's IOUs. At the same point, Americans, as well as the rest of the world, will realize that the U.S. is not what she used to be, and neither are her IOUs. For the first time in almost a century, faith in Uncle Sam will reach a nadir, and precious metals their apex. But faith, as I've also written, is a hard financial indicator to time. This is not good gold bug posturing, but hard math and political reality colliding with the lessons of current and past history. Take the pathetic example of Japan. The Fed's rate hikes have pushed Tokyo and its yen to its knees. The Bank of Japan, unlike the controllers of the world reserve currency, hence the Fed, flatly cannot afford to raise rates and pay its Japan JGBs, the IRUs, at the same time. Net result? The Bank of Japan is printing yen like gangbusters and keeping inflation deliberately above interest rates. Yet even in this openly negative real yield nightmare, the Japanese 10-year bond did not trade for 2 days. Meanwhile, as the yen dropped to 50-year lows, Japan was forced for the first time in nearly 3 decades to prop its currency by making a direct intervention in the forex, which entails selling a batch of U.S. treasuries it had on reserve. This explains why the TLT, U.S. Treasury ETF, lost 3% on the same day. Meanwhile, U.S. junk bonds, as measured by LQD ETF, fell to lows not seen since the COVID lows. Tanking junk bonds, by the way, are typically leading indicators for tanking equity markets, and just saying. And then there's the European Union, the EU. Japan, of course, would not be the last nation to reach such desperate levels, as more U.S. Treasury bonds are dumped and sold, debt costs in the U.S. will only get more, not less painful, regardless of what the Wizard of Powell does from DC Oz. Again, just ask the Bank of England and its recent headline-making pivot to more quantitative easing, QE. No shocker at all there. Foreigners own over $18 trillion in U.S. assets, including bonds, real estate, and dollars. Once a distressed selling starts, it goes from slow to rapid very quickly, which means pain levels for Main Street American debtors will rise equally fast. Other nations friendly to the U.S. are feeling equal pain from Powell's hawkish Fed and strong U.S. dollar. Germany, for example, is seeing yields in its 2-year bonds above 2% for the first time since 2008, an otherwise once anemic rate which it literally cannot afford. As yields in the EU rise as a result of its U.S. allies' policies, the EU starts to quiver and shake, as this means the EU's interest rates will rise as well. But with debt-soaked countries like Italy teetering towards Frankenstein levels, Powell is pushing the EU into a national security, currency and debt trap, as well as political crack-up. Again, what will the EU nations do? They'll likely turn Japanese and start dumping US treasuries and dollars to keep the lights on from Paris to Portugal. Even in China, big firms are already selling USD assets and commercial real estate, over $20 billion since 2019, at an increasingly alarming rate. Powell's strong dollar policy is backfiring. In short, Powell's strong USD policy, like the West's sanction against Putin, are openly backfiring as America's allies bend under the oppressive ripple effects and weight of an artificially strong US dollar, and all of this as the EU heads into a winter with less energy from the East. Then again, the Fed is always at least 2 to 3 steps behind its own leaning curve. As a political rather than independent bank, they can only rely on words and distortions rather than math and honesty when speaking to a public which they have served since the day of their official and Wall Street leaning birth in December of 1913. These converging currency, debt, and energy patterns look like the weather map of a perfect storm. In short, foreign currencies, suffocating under the weight of Powell's strong US dollar, will continue to tank as global bond markets continue to dry up and hence implode. Unless the Federal Reserve reverses course on its strong USD policy and pivots to more quantitative easing mouse-click magic, global markets face a legitimate risk of systemic collapse. But then again, more mouse-click money just means a currency crisis. Again, pick your poison. For all of these reasons, I remain steadfast that global currency and sovereign debt markets cannot and will not last long under Powell's current strong USD policy. Unless the Fed pivots to more pathetic quantitative easing and hence a weaker debased US dollar, in other words, print more dollars, the systemic risk discussed above will become systemic implosion. For now, the ball or the dollar is in Powell's court, and he's got a weak serve. So this is concerning what the dollar is going to do to the rest of the world. This is by Matthew Pippenberg via goldswitzerland.com on Zero Hedge. Please leave your comments. Thank you for your support. Kindly support my Patreon account. The daily posts are 5 videos daily, and they are totally different from what I have on my YouTube channel. Thank you so much for your support and that you find all my content so interesting. You'll find the Patreon account details in the description box below.